In this lecture, we are going to discuss annuities. What is an annuity? Annuity is a constant cash flow at regular intervals for a fixed period. A constant cash flow means cash flow of a constant amount at regular intervals, and it is for a fixed period, like that what we see in case of a recurring deposit or an equated monthly installment in a home loan. So these are examples of constant cash flow at regular intervals and for a fixed period. So these are called annuities, a constant cash flow at regular intervals for fixed period. Now this cash flow, it can happen at beginning of the period or at end of the period. It can be inflow, it can be outflow. The cash flow which happens at beginning of the period is called annuity due. So beginning of the period annuity is called annuity due. Example is payment of life insurance premium, which is paid in the advance in the beginning. End of the period annuity is called ordinary annuity. Like recurring deposit account in a bank. In recurring deposit account, the amount can be deposited by end of the month. So hence the recurring deposit account example becomes ordinary annuity. So when cash flow is at the beginning of the period, it is annuity due. When it is at the end of the period, it is ordinary annuity. Now how do we calculate the present value of end of the period annuity? Here we have this formula. Let us read this example carefully. Z is expecting to receive 9,000 annually for next 5 years. At 12% rate of interest, what will he be getting? So here we are going to calculate the present value of end of the period annuity. This annuity rupees 9,000 is going to be received in next 5 years. What will be its present value at 12% rate of interest? So we have this formula, and here we insert the value in the formula. So 9,000 bracket 1 minus bracket 1 divided by 1 plus rate of interest raised to power 5 period divided by rate of interest. So it gives us this solution. So we get further solution. So the value of the annuity, the present value of the annuity, 32,443. This 9,000 to be received for next 5 years would be 45,000, but its present value at 12% rate of interest will be 32,443. So this is present value of end of the period annuity. Now let us calculate future value of end of the period annuity. For this, we are going to use this formula. Z deposits rupees 10,000 annually for next 5 years. At 10% rate of interest, what he will be getting? So we place the formula and we place the value in the formula. So 10,000 is amount of annuity, 1 plus interest rate raised to power 5 minus 1 divided by rate of interest. So this is what we get. And finally, this is the amount we get. So this is future value of this annuity, future value of end of period annuity. So for this 50,000 to be deposited over 5 years at 10%, the investor shall be getting 61,051. So here we have given step-wise explanation.